Come on, keep coming, keep coming. The old stop sign. Now often when we see this in everyday life, the intention is to keep us out of trouble, to prevent an accident happening. And we use stops in our trading as well. I think it's the most important order type that you can use when trading, to prevent a catastrophic loss on the account, to minimize the loss on each trade that you take. But you can also use the stop order to benefit from those home runs, for those trendy markets that just don't want to pull back. So using a stop will allow you to knock that ball out of the park, so to speak, on those occasions when the market wants to keep on going. So today I want to talk about that order. It's called the trailing stop, why it's so important and how you can use it. Come on, let's go. Okay, so let's talk about the trailing stop. Now in a moment I'm going to jump onto the charts and I'll show you some examples of how you can employ the trailing stop, but it's important that you understand exactly what the trailing stop is. Let's assume at this juncture though you know what a stop order is. A stop order is an order that's placed in the market against an open trade that will get you out of a position should it move into loss, therefore maximizing the loss on the trade, whether it be 0.5%, 1% or what have you. So basically the market goes against you, you're stopped out of the trade, you're stopped losing any more money. That's basically what a stop order is. Now trailing stop is slightly different. Trailing stop basically trails price as well, and it has key fundamental differences as well. Let's have a look at it. First off, trading stop is going to always be associated with an open position. So basically it's tied to a trade that you have running at that time, as opposed to a pending order. You may have heard of the pending buy stop order or the pending sell stop order. A trading stop is always going to be associated with a trade that you've got running. And the trading stop is placed a certain distance away from where price is, and it moves in the direction of the price. So for example, if the price is moving up in your favor and you're moving into profit, then the stop will move with it as well, basically locking in profits as you go. Now the purpose of a trading stop is to lock in profits and keeps you in the trade for longer. You can have another way of trading where you have your stop loss and you have your take profit targets. This basically ensures that you can, if the trade wants to fly, then you can stay in that trade for longer. But these are best utilized in trendy markets. If you're using a trading stop in a market that really isn't trending, then you are going to get whipsawed about and it's going to end up costing you lots of money as you keep getting stopped out as you go. So you have to be confident about a trend or about a trend that's about to continue for you to use the trading stop effectively. Now there are multiple ways that you can execute a trail stop. I've homed in here on just the three, I think the three most common ways that people, traders, will use the trail. That's behind the moving average. So the moving average will move with the price, and the trail may be behind, above or below the moving average, depending on whether it's a buy trade or sell trade. Behind an average true range, that's basically the range of the candles over a predetermined number of periods. I think that's one of the most common ones. And the other way would be behind the previous candle high or low, depending on, of course, whether it is an uptrend or indeed a downtrend. So these are the three main ways, and these are the three ways that I'm now going to showcase to you. Okay, so first off, I want to show you a basic chart showing you how the trailing stop trails behind the price. Now I'm going to be using some back testing software here. That basically means I can scroll through each candle with a click of the space bar and you'll see the trading stop trail behind the price. Now of course you'll be using different platforms in your trading, and the way you enter an automated trading stop will differ as well. I will show you at the end quickly how you can do this on MT4, but every trading platform is different to this regard. Okay, so first off we're looking here at a chart. This is, what is it? This is the pound against the US dollar. Let's assume now that I want to place a sell trade with an automated trading stop. So I might want to put a sell trade in there with a sell stop there. I'm going to put a trading stop in. Say I'm going to put in a 100 pip trading stop. Again, everything is going to look different on your platform. The moment I enter the trade, the trading stop will be placed, and there you see, there it is. So we've entered a short trade. and the trading stop here is about 100 pips below. Now what you'll see now is as I scroll through price, the price is going to drop because I've obviously cherry picked this, so it shows you that it's working, and you'll see the trading stop come back in with it as well. So we had a bit of a pullback there, and then the market went into trend, and now you see we're now in profit, and the trading stop is coming back down, closing in on entry, and now the trading stop is now below the entry price. So the red line is the trading stop, and it's moving down, and it's locking in profits as we go. Remember, the blue line is my entry and the red is the trading stop, and off we go, and eventually it pulls back and hits the trading stop. So you see there basically how the trading stop was locking in profits as the market moved in our favor, and then ultimately pull back and hit the trading stop. That's basically how it works. Now we'll look at the 3 different ways that you can potentially use a trading stop in your trading. Okay, so first up, let's have a look at using a trading stop behind a moving average. So here we've got the pound against the US dollar. On my chart here, I have got the 50 period moving average. Now, of course, you need to decide on the moving average that you wish to trail behind. Remember, the lower or the faster moving average, the lower number, the more in tune to price the moving average will be. So, for example, if you're using a 1 moving average, it will be basically price. If you're using a 50 moving average, it will be away from the price. And of course, 100, the bigger the number, 200, 300, the further away from price it will be. Of course, the bigger the stops will be. So it is a bit of an art to decide on what moving average you want to use. I generally like to use something myself between about 40 to 50 moving average. But again, you need to do some back testing on that. Right, okay, so this is the 50 moving average. Let's assume here we want to take a buy trade. So I'll do that now. Of course, remember your platform will have a different way of entering. I'm going to place my stop just below the 50 moving average, and there it goes. Now, with this, you need to move it manually unless you have an automated program that's going to do it for you. If you're trading MT4, there are providers out there that basically maybe sell trading stop EAs that can manage the trade for you. If not, you'll need to do it manually yourself. But I'm not here to sell expert advisors, but you do it manually should you wish to. Right, so let's scroll on and basically show you what happens. So we need now to advance by clicking the spacebar, and every time the price moves up, I'm going to be moving my stop up. You see, I'm doing it manually here now, just below the 50 moving average. Okay, I'm doing it every few candles here. You might want to do it every candle, depending, of course. At the moment, we're quite far away, so we're okay. Okay, so as the price is moving up, the moving average is moving up as well. So I'm locking in profits as I go, just below the moving average. You see, up we go. The red line is the stop. It just allows you to stay in the trade for longer. Again, be considerate of the length of the moving average. The lower the number, the more likely you are to get stopped out. But the bigger the number, the bigger you will give back at the end when it does indeed pull back. So there is a trade-off to consider there. This one's going away nicely. Of course, I did cherry pick this for the idea of showing you how the moving average can control the trading stop, staying in this trend for a long time. So when you do get these home runs, they can indeed be pretty nice. And they eventually get stopped out. So I'm not quite sure the size of that trade, but it certainly was a nice one to ride that trend. That's trailing behind the moving average with the trailing stop. Okay, so now let's look at the second way that we can trail a stop, and that's using an ATR. It stands for average true range. Now, we have done videos on that in the past, but for those that haven't seen that, the average true range is basically the average range, which is the difference between the high and the low on a particular candle over a look back period. Usually the default that they use is a 14 period. Now, often you'll see traders use a factor of the ATR. So it might be 2 times the ATR or 3 times ATR. And in this short video, we will use the 3 ATR for an example. Now, normally with an ATR, as with any indicator, you go to indicators, insert. This is a momentum indicator, and you click ATR and it will appear at the bottom of the screen as it does here. And you of course can change that and make it bigger and smaller in the usual way. So here on this chart, it's a 1 hour chart of the pound against the US dollar. The ATR at the moment is about 30 pips. Okay, so we're going to use a 3 ATR. That's going to basically be a 90 pip trading stop on this 1 hour chart. And again, you can decide to use a 2 ATR or indeed a higher ATR. That is your choice, and that is something that you need to run through your back testing. So I'll place that trade now with a 3 ATR initial trading stop. Okay, so there is the trade set up. This is a 90 pip stop, and we'll see how price moves down and how the trading stop will follow it down as well. I'll just make that a little bit smaller as well, just minimizing the ATR. Okay, and off we go. Okay, so we're back to break even, and now we're moving into more profit. So the trend is now establishing itself to the downside. You can see that the stop, the red line, is moving in. Still maintaining 90 pip difference from the initial trade. Okay, and off we go now. You now see the trading stop is now in profit. So we're now locking in a profit by using that ATR trail. And off we go again. Almost hit stop there. And off we go again. Now we're locking in more profits. So you can see we did have a pullback there. Didn't take out the stop because, of course, we had a 3 ATR trail. If we had a 2 ATR trail, then we probably would have got stopped out on that. But, of course, there's always is a trade-off, as with the moving average version. The bigger the stop, the more you'll be giving back at the end when eventually you do get stopped out. People might say they don't want to get stopped out at all, so they have a big trading stop, big stop level. Well, of course, that's great, but when it does get stopped out, you are giving a huge chunk back at the end. If you're using a very small trading stop, chances are you're going to get stopped out more often than not. So there is a trade-off, and again, only you will know that once you've ran that through your back testing. Okay, moving back up, almost hit stop again there, and just missed it, and now the stop is moving back down, locking in even further profits. Of course, at some point it's going to come back and take the stop out. Almost there again. Look, almost 3 times there. That was lucky. And off we go again to the downside. And again we trade on lower. This is a good example. I've cherry-picked ones that work clearly. And there we go. We get stopped out eventually on the pullback into the trail. So using a factor of an ATR is another way that we can exit a trade. Okay, so lastly we'll look at using a trail stop behind price action, behind the recent high or low of the previous candle. Now this is going to be a sell trade, so we'll trail our stop behind the recent high of the previous candle. So let's now set up a sell trade with a stop in place, and we'll trail it as the prices move down. Okay, so I've placed this order. There's my entry, and the red line again is my stop. So we're in the trade, and now as we move down, I'm going to move my stop just above the recent high of the previous candle. And as we move down, I'll do a few at a time so I don't have to keep doing this every second or so. The high of that candle would have been there. Okay, and we keep on moving down. Okay, and again I'm moving the stop down behind the previous candle. So you see this candle here, previous high was there. Just moving down a few at a time there. You might want to do this each candle, bit of hard work that, but again you can do that should you wish. The previous candle high is where the stop is going to be placed. Just doing that as we go. Okay, and eventually it pulls back and hits the stop. Okay, so that is another way that you can use the trading stop behind price action of the previous candle. Now again, I've done this manually, as I mentioned a moment ago. There are expert advisors that you can purchase for MetaTrader 4, MetaTrader 5 that can do this automatically for you as well. Also other trading platforms, you'll be able to maybe automate this as well, depending of course on what platform you're using. But there's just an example of the 3 different ways that you can trail a stop to stay in the trend for as long as it wants to continue. Now, of course, there's two schools of thought, whether you should be using a trailing stop or whether you should not be using a trailing stop. It is really only for you to know. And I think the best way for you to know is to go away and backtest this against using static take profit targets and stop loss levels as well. Because you know, when you're using a trailing stop, you're always going to be giving something back at the end of the trend. Two schools of thought. I'll leave you to make your own decisions on which way you want to go. Okay, so I hope you found that useful. Hopefully now you can see the potential power of using a trailing stop in some of your trend following strategies. You can see how you've got the chance to hit that home run, to knock the ball out of the park, so to speak, to stay in the trend for as long as the trend wants to continue. Now, if you like the video, if you found it useful, do go and give me a thumbs up right now. I'll leave a comment as well. I do try to get back to most of them in due course. Don't forget to subscribe to the channel if you don't already do so, and hit that bell notification. That way you'll be notified the moment the next video has been released. You can follow us on all the socials, as you know. And don't forget, we are streaming live around the clock, up to 6 times a day, 5 days a week, discussing market opportunities and trading events as they unfold. So if you want to take part in that, make sure you do. And you can do so by clicking the link in the description below, take you to where you need to go. If that's not your thing, not a problem. I'll see you next week, and have a good week.